Have you ever been on a roller coaster that drops so steeply that your stomach flips, and just when you think it's over, it climbs up, back only to plunge again? That's basically the stock market in a nutshell. There's thrilling highs, there's gut-wrenching lows, and there's a ride that can leave even the bravest investors queasy. But what if there was a way to enjoy the upward momentum of the market without all the terrifying drops? Imagine a financial vehicle that captured some of the gains when the market was soaring, but shields your principal when markets crash. It turns potential years of loss and recovery into a steady, uninterrupted growth. That's the power of protection in action. That's especially crucial as you approach retirement years. And that's where timing those dips can make or break your nest egg. Hello, and welcome back to Not Your Average Financial Podcast. I am your host, Mark Willis, a certified financial planner. I'm the founder of Lake Growth Financial Services, and our mission here at our firm is to help you think and live differently with your money, your economy, and your future. And today we're exploring the profound impact of market volatility on your retirement savings specifically, but also on using tools like fixed index annuities that can provide a shield against losses while you're still offering yourself some growth potential. That's important. We need to be able to continue to grow our cash. So this episode isn't about fear-mongering or pushing specific products at all. It's about arming you with knowledge based on historical data, real math. I mean, if we were shown real data, would that make a difference? Market crashes are not black swan events. They're not rare. Guys, they're a normal part of the cycle. In fact, since 1929, the S&P 500 has seen over 20 corrections of 20% drops or more. They use the word correction. I think that's sort of a misnomer. It means you're losing money. If someone was stealing 20% of your cash out of your bank every couple of years, would you figure out a way to protect that bank? Would you move it to another bank, per se? 1 out of every 5 years, you're seeing a 20% drop in your values. So for retirees, or for those nearing retirement, recovering from a 20 or 30 or 50% drop is not just about patience, it's about lost compounded time that could never be recovered, right? That might cost you hundreds of thousands of dollars in potential growth. In fact, a study from the Journal of Financial Planning highlighted how the sequence of returns risk, that's experiencing a bad market timing, especially early in your retirement, can reduce your portfolio's longevity. That means you run out of money by up to 10 to 15 years faster than if you didn't have that downturn early on in retirement. So this early withdrawal, this early loss, or this early bad market timing might force you to withdraw your principal at the worst possible time. In fact, another analysis by Vanguard showed that high volatility in the markets can erode 20 to 30% of potential returns over a 30-year retirement horizon. This turns what should be your golden years into stressful years. But with the protection strategies of fixed index annuities, you can totally flip the script. This puts you back in the driver's seat. It turns volatility from a formidable foe into basically a non-issue that doesn't derail your plans. Now, psychologically, this matters to me big time, and hopefully it matters to you too. In fact, research from behavioral economists like Daniel Kahneman and Amos Tversky on prospect theory reveals our innate loss aversion. Losses hurt us emotionally about twice as much as the equivalent gains feel good. Let that sink in for a minute. This leads to panic during market downturns. It locks in permanent damage, and you miss the rebound that comes along at some point. No one knows when, right? So over a long period, habits that incorporate protection and principal growth build a resilience in your life and in your financial life as well, but in just your overall life, a confidence is built. And that's shown in studies where buffered portfolios, that's where we have stocks and bonds, but then also we have buffered it with whole life insurance or fixed index annuities. A buffered portfolio will actually lead to a 25% higher adherence to long-term financial plans. When you're not having to freak out because your principal, your important money is getting vaporized due to somebody's poor choice on Wall Street, you actually have a 25% higher likelihood of sticking to your long-term plans. So we're going to explore how to cultivate these habits later on in the episode. But first I want to get into the brutal reality of market volatility. Let's dive into this.